Matt Faircloth, and he is going to be speaking about moving forward into multifamily investing and what you should know in 2021. I know it's been a crazy year for all of us. There's a lot of trends that are changing in real estate. So I'm super excited to hear what he's brought for us tonight. He's done a lot of research before this presentation. But before we get started with the main presentation and kind of as we let people get signed on here, I do just have a couple of quick slides that I would like to go through about Quest. If you guys have seen our presentations, you've definitely seen these before, just kind of little intro about who we are and how we can help you as a real estate investor in today's world. But even if you have seen our events before, be sure to pay attention to some of our upcoming events that we have. I'll have them at the end of these slides, and we've got a lot of fun educational opportunities coming up, pretty much as we always do. So a little bit about us. Who is Quest Trust Company? We are a self-directed IRA custodian. We're based out of Houston, Texas. That's where our corporate office and most of our staff is based out of. Now, we do have clients pretty much all over the country. We do operate in all 50 states, and we have about $2 billion in assets under management. Now, where Quest can really help you as a real estate investor is we really specialize in teaching investors how to utilize self-directed IRAs to invest into non-traditional assets. So all of that $2 billion in assets under management that we hold is all either real estate, promissory notes, or private placement investments held in our clients' IRAs that they actually get to have full control over where that money is invested. So we offer a lot of great resources. This class is just one of many classes that we host on our platforms. And if you want to rewatch tonight's webinar, as well as any other of our webinars that we host, head on over to our YouTube page. We will link that here in the chat, here in Zoom. And really important here, quick disclaimer, Quest Trust Company does not give tax, legal, or investment advice. We are not your CPA. We are not your attorney. It is so important to do your own due diligence. Make sure that you are taking the time to structure your deals properly, look into the people that you are working with, and, don't rush into investments. Your IRA is 100% self-directed at Quest. And we really want to make sure that we give you the proper education so you can go out there and make the right decisions and do that own due diligence. But it's very important to kind of specify that difference there. Now, as I was mentioning, our clients and their IRAs at Quest invest their IRAs into non-traditional assets. So you'll hear of something that we call a self-directed IRA. But to be honest, all of the 7 different types of accounts that we hold at Quest are actually self-directed IRAs. So self-directed is really just a marketing term, but it's kind of what we use to show that you as the IRA holder get to make all of the investment decisions for your IRA. There are a lot of benefits to this where it does allow you to truly diversify that retirement portfolio outside of the stock market, outside of CDs and other sorts of publicly traded securities. And it allows you to have more control over where your money is invested. And last but not least, this is so important here, and it's kind of why I get really excited about IRAs, and that is the tax savings. So all of the various investment strategies that we teach about in our classes and that we bring in guest speakers to teach about, all of these investments can be done in an IRA, which grows completely tax deferred or potentially tax-free, depending on which type of IRA that you are investing with. So as a real estate investor, as your long-term wealth building plan and the ability to also pass on this money and these investments completely tax-free, it is so important to at least have a good basic understanding of how self-directed IRAs work and the type of investments that you can hold in these accounts, because it can really help to minimize your tax liability, not just now, but later on the road as well. If you potentially encounter any capital gains taxes, those could also potentially be tax-free within the IRA. Now, as I was mentioning, we do have 7 different types of accounts that can be self-directed. If you really want a true understanding of how each of these types of accounts work, how you have the ability to use these accounts together between you and your immediate family, I definitely recommend setting up a free consultation with one of our IRA specialists. We do also have several classes and educational resources on our website and on our YouTube page as well, where you can learn a lot more about the in depth of these types of accounts, maybe Roth conversions, the employer plans, and how to partner maybe these smaller specialty accounts in on your deals as well. So, I will have some information on how to contact an IRA specialist at the end of my few slides here. But these are just a few of the many investment options that you have with an IRA. Tonight, we are going to really focus in on multifamily, which does fall under private entity investments. But whatever you specialize in as a real estate investor, you have the ability to structure these same types of deals for your IRA and potentially completely shelter those investments from your own income taxes and capital gains taxes. Now, here's the 5 easy steps to get it started. To be completely honest, just call an IRA specialist. We will make this process smooth and seamless for you. We will help you learn how these accounts work, what your different options are. And then once you're ready to invest, we'll help you get the money moved over and connect you with our transactions team at that point as well. So, enough about that. Now, on to the fun stuff, my personal favorite. For those of you guys who don't know me, I kind of lead our business development here at Quest. I work very closely with all the other girls on our marketing team to help to put on all of these events for you guys. So, our main goal at Quest is to provide as much free, high quality education as we can. So, we do have a lot of great resources for you. We have a YouTube channel, lots of great videos there that we post every single week. We have an education center on our website. We host weekly webinars, as well as a self-directed IRA Saturday series where we bring in probably 8 to 10 different guest speakers every single month. So lots of great resources there. And last but not least, my personal favorite, these are our virtual networking happy hours that I actually personally host on the first and third Wednesday of every single month. The education's great. We host a lot of webinars, but, prior to COVID, we did host all of these events in person as well. I know a lot of you out there are really missing that networking aspect and the ability to continue to meet other investors with, like-minded goals as you do. So to kind of help to supplement this, we have a virtual happy hour. It's actually set up as a Zoom meeting. So everyone gets a chance to share their cameras. Everyone gets a chance to introduce themselves. And we've been getting around 50 to 70 high quality investors from across the US joining us every first and third Wednesday. And we get a lot of new people every time. And we also get a lot of repeat offenders, as I like to call them, or, people that like to join us. And it's really created an awesome little community and network that we have. So I would definitely encourage you to join us for those virtual networking happy hours. Now, those are all of our kind of like free general events that we have going on all the time. But we do also have a couple of large events coming up this spring. If you are a real estate agent in the state of Texas and you need some CE credits, we host a 3-hour free CE course. That is such a tongue twister every time I say it. It's a free 3-hour CE course, and it really dives deep into self-directed IRAs, private lending, how to use IRAs, to speak with your clients and to grow your real estate business. It's totally free. You can register through Zoom. And we also have our next edition of QuestCon Live. And I really enjoy QuestCon. I actually get to have a hand in hosting this one as well. But it is a full 2-day online virtual self-directed IRA conference. So this will be our 3rd edition of QuestCon Live. We started these up last year when all of our events went virtual, but we will have about 20 different guest speakers from across the US. And this version of QuestCon will be totally over private lending. So if you need money for your deals, if you are looking to raise private capital, or if you're looking to be a private lender, this will be a great event for you. This event does have a cost, but if you open up an account anytime between now and QuestCon, we'll give you a free ticket so you can start learning how to use that IRA account that you open up with us. Now, we are very easy to get a hold of. I want to go ahead and just skip over to this QR code right here. I love QR codes lately, especially now that no one wants to touch any paper. If you are interested in setting up a free consultation with one of our IRA specialists, go ahead and scan this code here. You can put in your information. We'll reach out to you tomorrow once we get back in the office. but we are always here to help. We're not here to sell investments. We're really not here to sell you anything. We are here to provide you education and kind of help to point you in the right direction when it comes to saving more efficiently for retirement. So, no matter what step of the process you might be in, whether you are brand new, just getting started and looking for resources, or whether you really need to have an in depth conversation about what your goals are for growing your retirement account, reach out to us. We are always here to help. I do also have Steve Sabaji online here with us moderating tonight. He is one of our IRA specialists. So if you have questions, feel free to send us a chat to either myself or Steve, and we will be more than happy to help you out. Now, that is all that I have for my quick announcements. Matt, let's go ahead and bring you back on, get your camera shared. I am super excited to have you back here with us tonight, and I'm excited to see kind of the research that you've done and see what data you've brought for us. I'm such a data nerd. But Matt, the floor is yours for about the next hour. Go ahead and take it away, and I'll come back on at the end for that Q&A.
No problem. I'm not sure if I'll go for the full hour, but I'd love to do as much Q&A as the audience wants. There's a little bit of data and a lot of Matt's opinion in this presentation. So thank you, Haley. Thank you, Quest Trust, for having me. It's been an honor to be here. I had such a great time at the last Quest conference that we had. And I highly recommend everybody look to attend Quest conferences because they're the speakers they bring are great. And the networking was great too, and it's been a great experience working with Quest as an organization for DeRosa Group. So bear with me one second, and I will bring this up. Okay, should be good to go. Haley, just give me a spot check to make sure that looks good to go.
Yes.
I always like to have. We're good. Okay.
You are good to go.
All right. Thank you. Okay. So today's conversation is going to be about the new rules for multifamily investing in 2021 and beyond. Again, as I said, I did pull down some data that I was able to get from a few different sources. But bear in mind that, unfortunately, my crystal ball is broken and I can't seem to get it fixed. And so a lot of what we're going to talk about today is going to be my opinion about the market and what the market's going to be doing. We good?
Actually, so your display settings switched on us. Can you switch it back? We see the kind of presenter background view.
Okay. Yep, that'll work. Okay. Good stuff. Is that better now?
It hasn't swapped just yet.
I'm going to stop and I'll come back and I'll do what you can.
Turn it off and turn it back on again.
That's
trusty old method.
How's now?
Yes, that's good.
That's good. Okay.
Yep.
All right. Thank you. So that's what today's conversation is going to be about, guys, is the new rules from multifamily and beyond. And also just how this lovely COVID and the economic shifts we've seen in the last year have changed multifamily investing. I would say for the good, but it's just changed multifamily investing. We can't go back to the way things were, nor should we, and we just can't anyway. So might as well accept what's coming down the pipe and move on. This is some data and opinions on that. So, a bit about me. Those of you guys don't know, my name is Matt Faircloth. I wrote this book, Raising Private Capital. I've been investing since 2005. When I quit my day job after reading, after my girlfriend, then wife, got me to read Rich Dad, Poor Dad. And that just blew my mind. It got me to do some investing on the side. My first investment was a home that I lived in and rented out to two buddies of mine. And then in 2005, when Liz and I got married, we agreed to live off of just her income while I started our company, the DeRosa Group. And we've grown into the business and done all kinds of fun stuff. Like fix and flips and multifamilies. And we own an office building in Trenton, New Jersey. And we've scaled up, got through the first recession. And so we've seen market cycles. We actually understand that markets don't just go up all the time. And it's not just an appreciation game. So we're seasoned through a couple of different markets. And my company's currently active in multifamily in New Jersey, Pennsylvania, North Carolina, and Kentucky. And I'm super blessed to see that some of the investors with DeRosa Group are on this presentation. So grateful to see you guys here. Thanks for being with us. Again, I'm the author of the Bigger Pockets book and the Amazon bestseller, Raising Private Capital, which I took a lot of the lessons that I learned from the multifamily deals that we've done, the office building, single family rentals, all that stuff, including a couple of dozen fix and flips. All that is in that book. And so if you guys should totally check it out, because it's a lot of what I know about this business is in that book. I live in Pennsylvania. I'm the father of a lovely 7-year-old boy and a awesome 3-year-old girl. You may hear them shrieking in the background because it's their witching hour right now. So if you hear screaming in the background, they are not children being tortured. It's just small children being put to bed. So let's talk real quick about multifamily and what it's done over the last 10 years. Okay. Now, this is a chart, and I got this data from Arbor Financial and so this is charting what they're calling small multifamily, right? We'll notice that this is small multi, right? Their definition of small multi, by the way, is anything under $7.5 million. That's the small multi to Arbor. Okay. But this is this is the national trend. Look at where small multi trades were in 2009 on sales volume. Okay. 2009, and it just slowly trends up, and that's 10. These are billions, right? 10 billion. And this is partly more and more people started transacting, but it's also prices increasing in that. So this isn't like a lots more transactions. This is also just, there's more transactions, but the transactions are also trading at more in dollars per unit because multifamily is becoming more and more of a hotter place to invest. We'll talk about why that is in just a second. But a few tips here. It's gone up a lot, but it's also become a safer bet to invest as people realize that multifamily it's housing. It's not going to go away. People have to have a roof over their head. But they may not need to go shopping in a strip mall, and they might not. And we'll talk about this in a second, but they may not even need to go to work in an office building anymore. But they still need a place to live, to call home over their head. And so if you look, multifamily trended like this. And a lot of this from my data research is recovery from the recession. And so this is kind of the market getting itself caught back up, if you will. And then it trends out of the line here, and then it gets overheated again. And then 2000 and COVID happened. And there were less transactions. It actually finished right around here. Didn't even get to their annualized projection of where they were taking it. It got about. But what's interesting is people would have thought that it would have gotten clipped all the way back here. It didn't. Growth got cut by what we estimate to be somewhere in the 25 to 30% range. But we're still seeing growth. There's still deals happening. Well, let's talk about. First of all, there's some why. Why did that happen? We'll talk about why it happened, and we'll talk about what's caused this run up. That's going to cause this run up. Also, is going to affect what we're going to see in the future here. One of the reasons why it got clipped, of course, is because a lot of people sat on their hands. We didn't see any transactions happen. A lot of brokers sat on their hands, and a lot of sellers sat on their hands. A lot of deals fell out from March through June, and then things slowly crept their way back in. But a lot of these transactions you're seeing here are from June up through the end of the year. They're from the first 2 months, if they close in the first 2 months, and then June forward. But there were deals that were at the closing table, and COVID hit, and they were pulled from the closing table. People probably lost a ton of money in earnest money deposits and non-refundable third-party fees and things like that in deals that got pulled away and did not transact. So bear in mind, guys, this is probably, I don't know, what do you think, about 9 months worth of transactions or so, because the world stopped for a couple of months and people just were not transacting in March. I mean, there was a time there you couldn't get a title company in March, April, in parts of May and things like that. So you just couldn't close. So this is interesting, and it looks like a big drop, but bear in mind it's not even a full year worth of performance, because we were we were in Stopville for a couple of months there of last year. So it's not as much of a drop, but I think that the other shoe has not dropped yet. And we will talk about what that looks like moving forward. So before we go further, I want to talk to you guys about what really drives, because people are like, Matt, that's Looney Tunes. How sales still happened and transactions still happened in 2020, and they'll still happen moving forward, as we'll see. So let's take a pause and discuss what really drives multifamily pricing. So, the price in multifamily is equal to the NOI, the net operating income of a property, divided by the cap rate. So if the NOI is 100,000 and the cap rate's 10, you divide the 100,000 divided by 0.1, and that gives you a value of $1 million. Okay. It's not as complex. It's not as simple as that. And we haven't seen a 10% cap rate in a very long time. If you see a 10% cap rate, run the other way, right? What a cap rate is it is a risk factor. Okay. There is the national average for cap rate for the United States, but that doesn't matter because the United States is not one big market. It's not one market in itself. It is a subset of hundreds of and maybe thousands of markets, right? So the cap rate in St. Louis is not the same as the cap rate in Denver or Boston or whatever. The cap rate, what a cap rate really is, think about it. It affects the price that I'm willing to pay to get this NOI. If this NOI is the fixed number, then I'll pay more. If the cap rate's lower, right? If this is down, I'll pay more I'll pay more to get a lower cap rate because I perceive the risk to be not as much. Let's say we're looking at Boston versus I'll make up a riskier city that's perceived to be risky, Detroit. Okay. Boston versus Detroit. I don't know the cap rates in those two cities, but I would be willing to bet you 10 cents that the cap rate in Boston is lower because it is perceived to be a lower risk factor than Detroit is. Now you might say, well, Matt, that depends on the neighborhoods of Boston. And you're probably right. But in general, the lower the cap rate, the better the lower the risk factor that investors are perceiving that market to have. Meaning, if I've got $10 million to put to work in multifamily and I want to achieve this NOI, I'm willing to tolerate a lower cap rate if it's a market that has a lower risk factor associated with it, right? So people say, okay, I get it. Well, now let's make NOI not fixed. Okay. The way that folks have played the game and the way that we're going to continue to play the game here in multifamily is by increasing this number. If I increase NOI and cap rate stays the same, let's say we're playing in Winston-Salem, North Carolina. That's one of the markets that the DeRosa Group invests in. If the cap rate stays the same in Winston-Salem, it's around 6.5, somewhere in there. If I increase the NOI on one of my properties by nominally increasing rents or by more effectively decreasing expenses on a property, I will drive up NOI, which then increases the price of the value of the property. Okay. That's value add right there. I've described what the value add strategy is, or the way it's supposed to work. Okay. Here's the next thing that drives multifamily pricing. This is, what is cap rate? Let's break cap rate down. This is a yield spread. If I look at we'll talk about this in a second, market interest rates. And you guys are, well, why are you talking about interest rates? Well, think about that for a second. If I'm agreeing that I want a risk factor of, I want to invest in Boston. And right now, currently Boston is performing at a 6% capitalization rate. Okay. You guys with me? Interest rates drop 0.5%. Well, that increases the yield spread or the profitability that I would be able to make in Boston because everybody's borrowing money, right? So if I'm borrowing money, I can borrow the same amount of money. It's going to cost me less because interest rates are lower. So that increases the yield spread that I get to make on that property, but that's not going to happen for very long because of competition and free markets. So what's going to happen is if interest rates go down, then cap rates go down. It's called cap rate compression. So cap rates start dropping to follow along with interest rates, right? So what's really happened, one of the reasons why, let's go back to this with all my highlights there. One of the reasons why this has happened is because of interest rates, okay? It's partly because multifamily has become more in fashion thanks to, the folks that have written books on it and that are doing run to the back of the room guru stuff on multifamily and everything like that. But mostly it's because interest rates have fallen off. And that. So let's take a look at another chart here. Okay. That's small multi, that's all multifamily, right? And there was another chart that I had that correlated this with interest rates, but it was getting too techy and everything like that. But just understand, as interest rates did this in multifamily, and as the 5 and the 10-year Treasury do that, cap rates just magically tracked along with it, right? And that's because it's the cost of capital. It's our cost of money. So that's what's really driving cap rates down. And that's why multifamily prices are getting higher. Okay. So that's a factor. We'll put a pin in that and get back to it in a second. Okay. Multifamily pre-COVID. And this is again, we're getting into a few things that are Matt's observations and that, but I think those of you guys that are active in the space would agree that these are pretty much true, agreed upon facts on what happened in multifamily in the 10-year run up. Appreciation was the primary profit driver, whether the syndicator or the owner wants to admit to it or not. They probably will tell you that they're just amazing business people and they bought a property for X and they sold it for 3 times what they paid for it 5 years later because they're just awesome and because they're amazing business people. But what really was going on is cap rates were going down, interest rates are going down, and so it's making these folks, a lot, making everybody that owned multifamily before the run up a lot of money in appreciation. And so appreciation has been the big profit driver, and a lot of syndicators were putting pre-COVID were putting out deals that produced very little cash flow during their time of ownership, but magically, magic fairy dust sprinkled on the property and it's going to sell for a ton more than what the person bought it for at the end. So you see these deals, you'll see like, hey, there's a 6% cash on cash the entire time of ownership, and then magic fairy dust and the property sells for 3 times what we paid for it. And that's how you get to your 18% IR, your magic 18% internal rate of return, Mr. Investor or Mrs. Investor. And that worked for a lot of the 20 teens, let's say. So the value add strategies overperform. So for those that were going to go and buy a underperforming asset and do what I said before, where they're going to go and invest and increase NOIs by increasing rents and renovating apartments and making everything really nice in the apartments and dropping expenses and making everything, doing the right thing. For those that did that, sorry, my camera's getting blurry. For those that did that, they likely outperform their goals. I've seen internal rates of return in the 40% range on deals that we're supposed to do in the mid-teens, but because of appreciation and because the markets they were in got really hot, those investors did very, very well. God bless them. But that was not the intention of the syndicate. They got lucky, but they kind of played the market the right way. Okay. Rising tides covered many mistakes. There are folks that overbought, overpaid for properties in 2015, pretty much wrapped the property around a tree and then sold it for, millions more than they paid for it. That happened. That didn't happen to us. We bought a property from somebody who did that in North Carolina just recently. But we believe that we can cure the failures that they made and really undo some of the work that they did. But there are people, Alex Rodriguez, the baseball player, we bid a property. We didn't buy it. We bid it, didn't get it. He bought a property in Wilmington, North Carolina, for $14 million 2 years ago. Bought it it was at 94% occupancy when he bought it. Okay. His crack team of experts, including one of his relatives, became the property management team on the property. And through their best efforts, they were able to get the property all the way down to 80% occupancy, and did a 4-prong renovation plan. It was really bad. And, the rumor in the city just was really a bad reno. He just went under contract for $22 million. Okay. On that property. So let's reverse analyze that. He bought it for 14. He maybe put $1 million into it. They wrapped it around a tree and then sold it for 22. Okay. Now that's partly because, maybe because of his brand and people can brag and say they bought a property from Alex Rodriguez. I don't know. But cap rates and also the ability to redo and undo people's business plans and do the right thing, are still there. But the rising tide covered a lot of people's mistakes and made folks money, even with their best efforts to screw the property up. They still made money, and sold them through rising tides. Appreciation made everyone look like a genius, and appreciation has made several syndicators look absolutely brilliant, and perhaps us too. Appreciation's helped us out as well, through deals that we've done. It's been a blessing for everybody. I don't think it's going to stick around. That's just, yet again, one of Matt's opinions, but I think we're moving into a new economy here, but appreciation has been a great blessing over the last, many, many years of multifamily investing. So this is pre-COVID, right? This is the market up to about, this time exactly 1 year ago. This is what the reality were. And for those of you guys that were active in the space as either passive investors or active operators, that you're probably shaking your head and say, yep, this is about what it looked like, right? Okay. Then this guy shows up, right? And the little Corona man shows up and, shut the world down. And we don't need to history lesson everybody, but we all know what happened. It really stopped our economy. It stopped everything. And it created, the biggest thing that it created is uncertainty. And we will discuss with that uncertainty, how it played into our marketplace and everything like that. Let me give one more chance to fix this camera and then I will give up on it. Oh, there's Matt. Okay, cool. I gotta get that camera fixed. Okay. Then everything changed, right? And so coronavirus came along, and again, it stopped our economy, lost a lot of jobs, and pumped a ton of money into the system too. And we'll talk about what that did. And it really just rebooted a lot of our world in that. So let's talk about the aftermath of COVID, right? COVID happened. A lot of people lost their jobs. And I'm not trying to make lighthearted of any of this, because I know you guys probably know people that lost their jobs, or know people that became ill or whatever from coronavirus. So understand, I'm not trying to be lighthearted about it, but it is something that affected a lot, and it is something that affected a lot of people. Food service and entertainment were hit the hardest. These are industries that were a discretionary income, and B, things that people needed to go out and be in big crowds to be a part of. Think about, like, when's the last time you went to a concert, or going to be okay going to a concert after coronavirus? That's something that may not happen for a long time. But things like that, and things that were either discretionary income or involved big crowds of people, were absolutely decimated, and a lot of blue collar, middle class America was deeply affected by this. Vacations go on hold, hitting recreational spots. Orlando and Las Vegas were untouchable as markets last year, right? We tried to get into Orlando. We gave up on it because it was just too hot, and cap rates just deals didn't make sense. I don't think the other shoes dropped yet, so I still would hold off a little bit on those markets, but they could become good target markets in the future if you believe that they're going to reboot and become what they were in just a year ago. But it affected markets like that. They relied a lot on travel, discretionary income, face-to-face conferences, things like that. So Orlando, Vegas, a lot of the other cities that benefit from those kinds of things were very, very hit hard, right? Overall migration away from cities. The hardest hit on that was New York and San Francisco. I saw some data when I was doing research for this presentation that San Francisco rents on 1 and 2 bedrooms are currently down 34% in San Francisco. Not that I don't think San Fran and New York are going to become ghost towns, but there are major corrections happening in markets that were at the peak, right? So New York, if you look at New York and San Fran, even if you looked at it macroscopically and in hindsight, we probably say, geez, I saw how this was probably not sustainable to begin with, on how people were going to pay, $5,000 for a 1-bedroom apartment, and maybe that doesn't make sense, to have it priced that high. But people are migrating away from high rent districts like New York and San Francisco. And we'll talk about the other effects of people migrating away from density in a second here. COVID changed people's actions, right? A lot of people made small actions. So small actions times a lot of people make big change. Well, what are some small actions that a lot of people made that changed everything? Most people are now working from home. I'm home. I probably wouldn't have been home a year ago. Would have been in my office. Excuse me. So most people work from home, allowing for more short and this has allowed for short and long-term migration. So those that used to work in New York City or in areas of high density are now able to move, right? So we are seeing a major shift in the United States of where people live. People no longer need to live near where they work, because where they work could be their guest bedroom. And it may be that way for the foreseeable future. There are less dense and more desirable areas that people are migrating to and leasing, especially near water, the woods, and the mountains. I live in Pennsylvania. The Poconos in Pennsylvania is absolutely exploding. And that's because people from Philadelphia and New York are saying, forget this. I'm not going to go and live in this 400 square foot apartment paying $3,000 a month. I can pay $1,500 a month and have a yard and a den and 3 bathrooms in the Poconos. And so they're not so much buying in areas like that. There's a lot of lease up happening, a lot of Airbnb, a lot of STR happening. And a short-term rental happening in areas that are near water, woods, and mountains. This is not a game DeRosa Group's playing, so we're not in STR, but a lot of my data research for this presentation showed a absolute spike in STR in areas that are near, that are less dense, near woods and near water. And the property prices have gone way up. My wife and I, we were looking at maybe, buying for ourselves personally a short-term rental either in the Poconos or at the beach. And we were seeing price increases at 15 to 20% in the last 4 to 6 months because people are migrating to those areas either to live or to rent just to get some fresh. It sounds joking, but just to get fresh air and to get out a bit and to get away from density and so they can social distance appropriately but still have some outside time and that has to do with this, right? That they can work their job from somewhere else. If as we allow more and more people to telecommute and work from home, they don't have to be home. They can work from their Airbnb, or from their RV, which that's happening a lot too. Right. Major drop in interest rates fuels housing purchases and investment purchases, as I said. So rates, because the federal government printed a ton of money and because the Fed saw what was happening, rates have continued to go down. We're pretty much at the federal treasury rate for short and long-term treasury debt right around 0%, in the like small decimals. And there's no way that we're going to get away from that anytime soon that I see. Again, this is what Matt thinks, this is Matt's crystal ball. But I do not see, and the folks that I highly respect do not see interest rates going anywhere anytime soon. Maybe down a little bit more, but not up, certainly not way up, because there's no recourse for that. It would really hurt a lot of things that we have in place. And to be straight, the government has created a ton of debt for itself in printing all this money and in stimulus checks and things like that. So if the government increased the cost of increased treasury bills and things like that, you would actually be they would be increasing their own debt service and costing themselves a bunch of money. So not saying that it's in cahoots like that, but why would they do that? So I think we're going to see low rates for a very long time. What that means for home multifamily is that's going to keep cap rates down for a long time. And we'll talk about that in a second, about how that's going to affect things. So now here's a few more things that COVID affected, and that I think, that I keep saying the other shoe hasn't dropped. This is what I mean by that. These things are what I believe have begun to happen, but have not finished happening yet. Okay. Things that were happening already got sped up. If you guys look at what COVID has created, if you really think about it, it was already happening, right? People were already starting to work from home. It's just all of a sudden, boom, now everybody works from home, right? Everybody probably wished they had bought Zoom stock about a year ago, right? So now a lot more people are working from home. Almost everybody's working from home. But that was beginning already, okay? If you look at COVID, it really just accelerated that. Okay. COVID has accelerated, and this has not begun yet, but we're starting to see a lot more of this, of flex hours. The concept of working from Monday through Friday from 9 till 5 was starting to go away in America, but COVID has 100% made that not the case anymore, because people can work in the evenings and people are homeschooling their kids, but not out of necessity, not by choice sometimes, but because they have to, because their schools aren't open or whatever it is. And so they are having to work flex hours. And so the concept of Monday through Friday, 9 to 5 is likely going to go away. I think in a couple of years, it'll go away completely. So retail and doctor's visits going online. Retail was going online. Everybody was starting to buy on Amazon simply because it was easy. But now people are buying on Amazon and buying on Pinterest and Etsy and all the other stuff too. And Walmart and Target, and all those guys are going online too, because it's convenient. But now people are doing it because it's more sanitary, and because it's no touch, and because I don't have to leave my house, and I can just stay more productive and do those things, right? So also doctor's visits were going online, and people probably scoffed when you said, "Oh, you're gonna one day you'll meet with your doctor and you'll just go into your camera on your computer." Well, people are like, oh, no way. Try it now. My sister's a nurse. She's doing most of her consultations are on Zoom or online with her patients. And many doctors are doing their consultations online. We're going to see much more of this. So that affects real estate, not multifamily, but it affects the world that we live in, which will affect a lot of different things as well. Okay. Less driving and resource consumption. If you guys remember, but during COVID, when things were really shut down, do you guys remember all these oil tankers that were off the coast of the US and nobody wanted to buy their oil? And we had such a surplus of oil, you could pretty much get oil for free, for like the oil futures had dropped pretty much to zero. It's, people were making jokes online about filling up their bathtubs full of oil, of sweet crude, because like, I can get it for free. You got to be able to take delivery, but only a tanker. That's all you need to take. But we are going to consume less resources and drive less in the future, and that's going to affect where people live, which will affect multifamily. Quick story: I drive a Jeep Wrangler, which I love. I'm on a lease on it. I'm supposed to be at 36,000 miles on it right now, as of right around now, based on how far I am into the lease contract. I am a little more than half of that, because of I just didn't drive it a lot last year. And it's not because of me, it's because America didn't drive as much last year. And so we are going to continue to see that as things move along in this world, right? Now, just bottom line, COVID has created many changes that we don't see or are not aware of yet, and more is on the way. So if you guys want to just get your creative juices thinking about the world that COVID has created, then you can probably extrapolate it out. Maybe just have a glass of wine with a friend of yours, or maybe on Zoom or whatever you want to do, and talk about where you think COVID is going to take the world 5 years from now. I like to think about what's COVID going to, what's America going to do with all the office buildings we have if we don't need them anymore, if we don't need as many of them anymore? What are we going to do with all these retail strip centers? I'm not planning on cooking all 3 meals a day for myself forever. I'm going to continue to eat out when we eat out already and everything like that. But how are food deliveries and retail and things like that, and food production going to change? Does that affect retail jobs? Does that affect blue collar jobs? Does it affect white collar jobs? I don't know. Let's talk more about it, right? So, a few things. The new economy that COVID has created, that my research has shown, is as follows. Okay, here are the pros. Calling the good things about and it's awful to think like, yeah, COVID, this awful pandemic that's killed a lot of people and has caused a lot of strife, has created good things. But hey, call me an optimist. But this is maybe years in the future what we will look back on COVID and say were benefits of it. Rates remain low for the foreseeable future, thanks for all the printing of the money and everything like that. So rates are going to stay low, and there's going to be no incentive for folks to put money in savings account and earn like a 0.5% interest, right? So money's going to stay fluid because it's going to need to go somewhere. So getting capital for deals is going to continue to be a thing that it's going to be on the easier side in that. And so capital is still going to be looking for a home, because savings rates are going to stay low, and interest rates to buy property is going to stay low too. I believe, right? And this is an interesting, because I've referred to a lot of this, but what this really piles up to is high income earners will become more mobile, right? They'll either work from home or they'll work from the road. I know multiple people that are working from an RV right now, right? That are on the road either with family or without family, and they are traveling all across the US, seeing the world, man, within their RV, and they're working. And they'll stop and they'll pull up their laptop and do the thing for a couple of days. And then maybe they'll hit the road and go, hey, where do you want to go today, honey? Sounds awesome. Right. But they will pay, so that's the benefit to high income earners and for white collar America. But white collar America is going to pay more tax. They just are. The current administration that just got elected, is going to, they're going to see to that. And a lot of the cost of printing a lot of this money is going to fall upon the shoulders of the white collar worker. And it's going to make life more expensive, but in exchange for life being more expensive, in exchange and higher taxes, the white collar professional and that is going to have more versatility and likely maybe not have to go to an office all the time. or maybe never. They'll be able to do. They'll have a lot more versatility for what they do. Not so true for the blue collar worker, for the low and middle income worker. They're not going to be working from RVs. They're not going to be living in Airbnbs or whatever, because they don't have the dispendable income to do it. And just they can't go to their work on Zoom. Okay. And so as much as a lot of us can do that, a lot of middle America and a lot of blue collar workers will not be doing that anytime soon. So we can't just say that, we don't need office spaces and we don't need places for people to go to work, because there are plenty of people that just can't do what they do remotely. And that accounts for white collar workers too. That accounts for, doctors that need to do surgery and things like that. A lot of things have to happen face to face. So the benefit that low and middle income earners will get is they're going to get a lot of benefits. They're going to continue to get stimulus checks. They'll probably continue, unfortunately, to get things like eviction moratoriums, and they'll probably continue to get other social benefits that will fall out from COVID, and also from the Democratic administration that just got elected. So they're just that's who they're going to target for plans that they have out as low and middle income earners. We're likely going to see, Biden's already talking about a $15 minimum wage. It's something that's been talked about for a long time. Some big companies, I believe Amazon does a $15 minimum wage. So we're going to see more and more, we're going to see higher income for low and middle income earners. And it's a $15 minimum wage isn't just going to bring up the very bottom. It's going to push everything up, right? That means that there's going to be a lot of wage increases for blue collar Americans that are out working. So that's a good thing for them. And I'm grateful to hear that. Unfortunately for them, that what's going to happen is that, again, this is Matt's opinion, but what's going to happen is it'll likely drive up the cost of things, and that was going to create inflation, and it will cause a gallon of milk to eventually be $7, unless you guys already drink the bougie, non-homogenized nice milk and stuff like that. That's already $7, but the cheap milk is going to be $7. The expensive milk will be 14. But I'm joking about bougie milk, but a gallon of gas will go up. Everything's going to get more expensive. As we pay, people more, it's just going to get more. And what else is going to go up? I believe rents are going to go up. And that increases NOI, and NOI applied to low cap rates, if played in the right equation, will continue to stabilize and keep multifamily propped up. But I don't see a crash in multifamily anytime soon, guys, because I think that more and more money is going to get pumped into the system through our tenants. They're going to get more money, and if you take tenants getting more money and you take cap rates staying low because interest rates are low, you're going to have NOI go up. Now, it's also going to increase our expenses, taxes, insurance, our cost of labor, because I still have to hire people to do stuff in our properties and things like that. So I might have to pay somebody more to do what they do. But I think the net gain will be higher on NOI, because income is going to go up on multifamily. There's more to come. That's not the end of Matt's of my opinion here, but that's one thing that I think will come out of this thing as a pro. Okay. Now, here's the downside of some of the things I think we'll look back on COVID many years from now and see what it caused on the downside. Tenants and investors will continue to have uncertainty in the future. If you were to, I saw many charts. Again, I could have charted you guys up and down the street, but I decided not to my eyes tend to cross when I start looking at too many charts. I'd rather just tell you what I found. So tenants and investors and just everyone in America, if you look at their consumer confidence, and that's something that's a factor. Consumer confidence and people's just overall uncertainty is way up, and rightfully so, man. Nobody had COVID in their underwriting. Nobody expected this to happen, except for maybe Bill Gates. But over a year ago, nobody expected COVID to really something like this to really happen. And so because of that, it took the knees out from almost everybody. And so because of that, people aren't sure what's going to happen next. And not to get too morbid, but yeah, I mean, people aren't 100% sure what's coming down the pipe next, right? Like what else you got? Zombie apocalypse? What else next, right? So there is uncertainty. And because of that, it will cause investors to be less nimble and maybe sit on their capital a little bit more. It will cause tenants to be less likely to jump on opportunities to lease. Maybe they're not going to move. Maybe they're not going to move to new cities, whatever it is. But we're going to see uncertainty driving people's decisions for the foreseeable future. The ability to push rents to the ceiling may be going away. Again, it was a good run at it, guys, for just, bumping rents, whatever you want, and not being sure where the top of the market was. Who cares? We'll try and increase rents $500, see what happens. That may be going away. There's still value add. You can still do that, because if everything around a property is getting more rent than the property itself is, then yeah, that's classic value add. But going into a market and saying, hey, I'm buying in a multifamily apartment building and the rents are $1,000 a month, and I'm going to try and get rents to $1,300, even though nobody in the market is charging $1,300. I'm going to do that. That plan likely would have worked a couple of years ago. I would not recommend anybody try that plan now, because that's going into uncharted territory, and uncertainty from tenants and residents would likely be what holds that business plan back. So those with high, again, this is speaking against those that believe the bottom's going to drop out of multifamily, or that multifamily is going to get cut in half, or those that are sitting, rubbing their hands together, waiting for multifamily to go on sale, or for 2008 to happen again in multifamily. I don't believe that's going to happen unless somebody really, really wraps it around a tree. And I mean, if A-Rod can pull a deal out and do well with it, so can you. Those with high risk deals on short-term loans that are going to expire and not enough reserves. This is what's going to hurt them. Not enough reserves. They may get into a pinch, right? But they'll likely be able to liquidate if they bought it for the right number. Even people in distress, and we've already gotten calls from like people in distress that are walking around going like, "Hey, I might be selling my multifamily. I'll sell my multifamily." They likely won't lose it to foreclosure. They'll likely just sell it embarrassingly and get their investor capital back and move on down the road to the next deal, but they're likely not going to have to give it back to the bank. I don't see that happening in mass. I see maybe a few deals happening here and there, but I don't believe the bottom's going to drop out like some other folks have predicted. That's just my personal opinion, but I think because cap rates are staying low, and because there's still hungry capital looking to get to work in the market, I don't think that we're going to see the bottom drop out anytime soon. Okay. Now, markets with too many job sectors are at risk. This is something that's a con as well. And I think again, go back to Orlando and Vegas, but also think about other cities that have too much of one thing again. And I'm sorry for those of you guys that are already invested here, but I would personally not invest in places that are super heavy in one market. Like I think of Houston, and I have friends that are invested in Houston. Probably not something I would do in Houston, because it's just too much oil and gas. Because I would want to see what happens to oil and gas. I want to see what happens to the automotive industry. I want to see how COVID affects how often people are driving. I see how little I'm driving, and I'm thinking like, well, there's probably other people like me out there. And that, so I think that it makes me wonder about that. Now I've got a solution to this. So let's stick to Matt's multifamily investing rules for success. Okay. Now these are the rules the DeRosa Group is taking on, but we've put a lot of research and a lot of homework into this. So this is where DeRosa Group, my company, is going over the next couple of years. And these are going to be our rules of engagement, and y'all are more than welcome to steal them and use them for your own business or recommend them to syndicators you guys work with. So prior to COVID, cash is king, right? And it was. And no, I'll keep cash, and enough cash in the deal is king. And if I've got enough operating capital, I'll be okay. What's true post COVID is cash flow is king. Okay. Now, what I mean by that, what I mean is if we look for deals that cash flow day one, and that is because I was around in 2008. Okay. Rents pretty much didn't dip very much in 2008. And if there was a major recession, yes, folks are going to lose their jobs. But at the end of the day, if that person loses their job, and once the eviction moratorium burns off, and it will, it's not going to stay forever. And these even talk of now we've already gotten compensated a ton by state programs for folks that can't get evicted, or that are down on their luck or lost their job because of COVID or whatever. We've made a lot of reparations with those tenants through state programs. So it's not, landlords aren't starving. There's a lot that we've done in getting clean with tenants that are behind. So cash flow is king. And let me Appreciation may not be guaranteed anymore. And that's because, maybe cap rates kind of stay the same. Maybe we hit a little bit of a glass ceiling. Cap rates really can't go in much further down because interest rates can't go much further down. So we might be hitting a floor, if you will. So I do not believe that somebody looking to go in and buy a property for X and sell it for 2X is a good plan. Now there's still value add. You can still increase NOI. And so if cap rates stay the same and your NOI goes up, your price does go up, but you can't say that the market's going to continue to rise and it's going to pull up the property you bought in certain markets or anything like that. Okay. This is a property here called the Preakness that we bought in Lexington, Kentucky. This property we purchased and it was making good cash flow the day that we bought it. And we were able to juice it and increase it from there. It was 98% occupied day at closing. We've been able to keep it around there throughout ownership, and that property is now worth a good bit more than what we bought it for, mainly because we've driven up NOI by taking what was so and just increasing it and making it better. But yeah, turning something around that's a loser the day that you buy it is likely not going to be the right, that's going to be a violation of Matt's rule number 1. Okay. Avoid business plan where the only way the deal works is to do big rent increases. We are trying not to increase our rents any more than 15%. And that's even with big value add. That's with new kitchens. That's with like new. We're still not pushing very hard on rents. I'll rather just keep the cash flow and keep the tenant in and not rock the boat too hard on occupancy. So avoid business plans where the only way the deal makes money at all is with big rent hikes. And those deals are still being circulated by other syndicators. But if you're looking to invest, I would be leery of something like that. And if I were a syndicator, I would be looking to change my plan about trying to ride the wave, because I think that the water may get really still soon. Maybe no more waves riding up, right? Rule number 2, jobs. If markets were increasing and adding jobs, that was fine, meaning like cities like Houston and Dallas and things like that, and Orlando and Vegas are increasing in job. There's companies coming in pre-COVID. That was all you needed to hear. Okay. Jobs are coming in. Phoenix, Arizona, perfect example. Companies hiring. I'm in, right? Austin, Texas. Right. That's all great. But I think what's going to matter now, and a factor that we're considering, and some of those cities, by the way, still fall into this, diverse jobs. What I mean by diverse jobs, markets that rely heavily on one job sector can be at risk in this changing economy. So a factor DeRosa has is that we will not do a deal if there's more than 20% reliant upon one sector. DeRosa won't do it. That's why I wouldn't do a deal, a city that's heavy reliant upon oil and gas or upon automotive or upon anything, entertainment, name it, shipping, and I'm not judging oil and gas. I'm just saying that's an example of a city that relies heavily on one industry. And that. So, but we just bought a deal in Winston-Salem, and it's a very, very job diverse city. There's a lot of jobs there, but they're very diverse. There's light manufacturing. There is banking. There's also education. Maybe that's a dicier market. I didn't talk about education in this portfolio in this presentation, but I believe the way America gets educated is going to change a lot because of COVID. I'm talking about higher ed, even grade school is likely going to change a ton. But I digress. Didn't go there here. We look for markets that are 20%. There's no more than 20% of the job sector in a specific city are reliant upon any one industry, and that's because if we see shifts, and again, the other shoe hasn't dropped yet. COVID's effects have not fully worked its way through, and there's a lot of effects that COVID has that we don't know of yet. And so, because of that, I don't want to put all my eggs in one job sector's basket. And so because of that, we look for major diversity in cities, and we highly recommend that those that are looking for places to invest. And it's super easy to find out what sectors are employing in a marketplace. So just we look for less than 20% per sector. Okay. Rule number 3, excuse me. Right. You would say market peak. What? What's the top of the market? I don't know. Let's just let's keep increasing rents and see what happens. Oh, geez, people are renting. Let's keep increasing the price on our fix and flips, or keep increasing the price on our multifamily. Oh, geez, people are buying, right? The top of the market was not something that people really discussed pre-COVID. And now it's something that's going to be all about, you got to know the peak. What is the peak of the market? Do you know what the top of the market is? Because it's going to be something that I don't think the market's going to be as absorbent to whatever you want to throw out there. I think the market's going to be way more sensitive because the uncertainty factor I talked about earlier, right? The market may not absorb mistakes and pay too much for deals moving forward. So people are going to be more scrutinous. And if you wrap the deal around a tree, you may have to pay the piper for it, or may have to stay in the deal and fix it and stay in the deal and maybe pump in more capital and stay in the deal until it does work, right? But you're not going to be able to just didn't work out, let's sell it and make a couple million. Not going to work out like that. Consider deals that are not at the top of the market now. And so we look at, that's a big thing for DeRosa, is we rarely buy the most expensive property to market. We look to see what else is traded, what else is going on in a marketplace rent wise, what else is going on in a marketplace price wise. And we'll likely try and be towards the middle versus the top. And that's been something that we do, that we've been doing pre-COVID, but we'll be doing even more post-COVID, because we don't want to be, I believe if a major recession hits, it's going to happen at the top, meaning like the more expensive properties are going to fall first, and more expensive properties are going to be the ones that are going to feel it more, because people are going to retreat to affordability. And so the person living in the A may drop down to a B, and the person living in a B may drop down to a C class piece of real estate just to save money. So I don't think living at the top is the right way to do it. That has made people a ton of money up till COVID, but I think that is way too more risky than folks should be playing post COVID. Class A and B plus can be risky. And again, I'm not just throwing rocks. I'm just saying class A and B deals tend to be leaner. They tend to have lower yield spreads. They tend to be the ones that are producing, 6-7% throughout the life of the property, and they sell for more. And that worked up until now. Those are more like your trophy assets and things like that. Like, I bought myself a new construction apartment building. Well, that may not be the deal that makes a lot of money moving forward. It did up until now, but I don't think that's going to be where I see a lot of money get made in the in the next couple of years. Now, again, I'm tainted, I'm biased because DeRosa really sticks to B and C properties. We are more of a workforce housing provider. That's really what we stick to, and so that's the market that I know. So put a total a total like asterisk on this, because this is really, it's strong in my opinion, but it's also the market that we know is B and C class assets. But I invested in B and C during the last recession, and it just hummed right along. The property value might have gone down, but tenant income did not. And I think that the government will continue to support a blue collar America, and the blue collar man or woman living in one of our properties. If they lose their job because the company shuts down, or because they get laid off because of COVID or whatever, they can find another job making their wage rate, making $40,000, $50,000 a year. Whereas the person making $120,000 a year that lives in an A-class asset is likely not going to be able to find another job like that. And so they may have to dial back and live in a B or a C property while they get their legs back underneath them. Whereas the blue collar tenant may have another job that week, if they want one to go out and get one. So, now, rule number 4, right? Talk about upside. Everybody was all about upside. When you were evaluating deals, people were talking all about like, oh, what's the IRR? I want to make in the mid-teens IRR. I want to make 20% on my money, right? Everybody was all about, what am I going to make on the end of the property? How much am I going to make when it sells? What's going to be my big return on investment, coming from the property? And I want to make a big upside and make a big hit, right? Because they see that happening all around, right? Now, the conversation of consistency is going to come more and more into this world, right? The buzzword over the last 10 years was IRR. And if you look at what IRR is, briefly, is the total return you make on an investment in something. So that's in real estate, that's cash flow, mortgage amortization, paying on your mortgage, and then the property profiting when it sells, maybe refi proceeds coming back. All those things all factor in. And IRR is mostly driven by the profit that when the property sells, or by money that comes back when the property refinances. We're going to see less and less strategies like that work, that are heavy IRR slanted deals, where deals don't make a ton of sense during ownership, but are going to sell for a lot more. I don't think we're going to see many more of those deals we may see a lot of them circulated, but a lot of them aren't going to maybe come to fruition or might not achieve their numbers because, the market may not be willing to bear big bumps in NOI or big bumps in pricing. The buzzword that I think that we're going to be talking about more often, we've always talked about this, is I've always been a cash flow dividend guy. That's what we try and produce, and that's what we aim for. Yeah, profit on sale is great, but I try and produce dividends. And that's, call me just a student of Kiyosaki, but I'm more of a cash flow investor versus appreciation investor. Cash on cash return is going to be the driving factor in multifamily. So it's not going to be, hey, how much am I going to make when the property sells 5 years from now? It's going to be, what am I going to make on a quarterly basis? And a lot of syndicators run around just paying the pref during the life of ownership of the property. That's going to be hard to do. That's going to be hard to be competitive with deals that are out there that are paying more than the pref during ownership. Our average cash on cash for a deal that we just closed was 12%. Average cash on cash. It wasn't just a pref. It was a good bit more. And so that can happen. And you're going to see more and more of that as syndicators go in and as investors obviously demand more cash coming from the property during ownership versus all of it coming back on sale. And that goes back to uncertainty, that people want to see health and cash flow coming from the property during ownership. We're already seeing a ton of this, and I know y'all have already seen it, but I could probably name like 5 syndicators off the top of my head that are all doing blended funds and invest in. And now hey, guess what? We're doing it too, right? But we're doing more investment in multiple classes. What you're seeing a lot of blended funds come online with folks doing in multifamily is people are saying, okay, I'm going to invest in my fund, and I'm going to take your fund proceeds and I'm going to go and spread it out over my next 3 deals, right? That's more common what you see. What we're going to be looking to do is true diversification outside of multifamily. So yes, it's in multifamily, but also in other things. You're also going to see people and investors are going to demand more liquidity. Investors are going to say, that's great that you want to lock my money in for 5 to 7 years. No, I see more uncertainty in the market. So I'm not going to be okay being locked into your deal, Mr. Syndicator, for 5, 7, or 10 years. So you're going to see more options for liquidity come out. That's something we're working on. And that's something I see the market demanding more and more liquidity, meaning, get my money back sooner than 5, 7, or 10 years. And so that's, I think we're going to see more and more of that. I should also highlight one more thing, guys. This is all my opinion, and I could be 100% wrong on all of it. It is based on a lot of data that we pulled. I apologize for not just choking you guys down with a bunch of charts and things like that. The majority of the data that I got, that I researched, was from Arbor, ABOR, and CB Richard Ellis. They both have a ton of charts and data and research, and CoStar too. Some of you guys might not have access to CoStar. But there's a lot of data on those resources that you guys can research. It's all out there for free. So do your own homework too, and then put your own opinion on this, because this is like data that Matt pulled down and then Matt's opinion put on top of it. So that's what I got, guys. That's the end of the presentation. I'd love to do Q&A if Haley will let me stick around for a little bit. I want to just mention a few things to you guys. And this is my wife's podcast, The Real Estate Investor Show. It's been a phenomenal journey for her, for the just documenting the woman real estate investor. But what's great is men are allowed to listen to it too. So they're not going to kick you off the podcast if you're a girl, if you're a woman, if you're a man and you listen to it. So, but they do highlight the path of the successful woman real estate investor. This is my Amazon bestseller book, Raising Private Capital Through Bigger Pockets. A lot of my thesis and investing philosophy is there. Investor first. That's really my main thing. And you can find out more about us online at derosagroup.com and on YouTube at youtube.com/DeRosa Group. We put out several videos a week on our YouTube page. And if you guys want to get a bunch of free resources and join our insider community and get direct access to me and my team on a regular basis, just text the word DeRosa, my company name, to 66866. It's not case sensitive. I am here for you, for your questiones. Hi, Haley. How are you?
Hey, Matt, that was a great presentation. Actually,
thank you.
I'm going to text that myself so I can get on your list and get those resources.
You should totally join it. Yeah, man. We'd love to have you as a part. Let me, would you like for me to start just burning through Q&A, or do you want to read them off? What do you want to do?
Either way, typically I read them off.
Bring it on.
But if you see one on here that I'm not getting to yet, feel free to go ahead and answer it.
No problem. Go ahead.
Awesome. So I like this question from Paul. I know, well, this may or may not be, like right up your alley, but want to hear your opinion on it. What's your opinion on the best way to find properties to purchase with such a lack of inventory on the MLS?
Okay. So Paul, if you're talking about the MLS, then you're probably talking smaller multi, like, I don't know, 5, 10, 15 units, somewhere in there. Two things. I would certainly expand my reach outside the MLS, because most MLSs only list up to 9 units, right? So get yourself LoopNet. And before people like, no, LoopNet's a place where deals go to die. Well, yeah. And brokers typically put their deals that don't sell very well on LoopNet. But what LoopNet will enable you to do is you can connect with commercial brokers that do sell a lot of multifamily. So you can call them and say, hey man, I don't want your really, really overpriced, piece of what property on LoopNet. But what I'd love to have is your next property you have listed. It's a great way to get to meet commercial brokers that are active in the cities that you want to be in, Paul. So look on LoopNet. If you're so inclined and you want to get aggressive, you can go to ListSource and buy a list of all the small multis in your cities that you want to be in, and send them a mail or cold call them. And also use the deal. You can use Deal Machine, the app, to call owners direct. You can send letters through Deal Machine, and you can use ListSource to get a list. You got to buy the list. It's like, whatever it is per name. But hey, if it gets you a deal, it's worth it.
Awesome. Great answer there. I like this question from Kevin. Kevin wants to know, do you think some syndicators will extend their initial exit timelines to wait out the market?
Absolutely. Yeah. Well, you know what though, Kevin? I mean, I had a great adage that somebody gave me a long time ago. You can't change the market. You can only hope to participate in it. And so if a syndicator's got a deal that either is cash flowing or waiting on cash flow or looking to come around or whatever, and whatever happened, to the deal that it didn't perform exactly the way it was supposed to, they may have to wait for the market to produce those investor returns. And I think that it's actually good for the syndicators, really the captain of the ship, and their job is to maximize investor profit. And so if that means we got to wait another year or two, investors should be thanking them for that, because that means that they're probably doing it not because they feel like it, but because it's going to get investors the best return.
Mm-hmm. Awesome. Great information there. Jeremy wants to know, Matt, what markets are you looking at in 2021?
That's proprietary. I can't say. No, I'm kidding. We are, and there are a ton of great markets in the U.S., Jeremy, we can't invest in every good market in the U.S. Because there's only so many of us. So there's, we've got a reasonable sized team, but it's also a focus thing. So the markets that we like are on this side of the Mississippi, on the East Coast, just because proximity mostly. But we are active in the Piedmont Triad. So Winston-Salem, Greensboro, High Point in North Carolina. We also have a property in Fayetteville, North Carolina that we're going to be selling soon. And we're kind of semi-shopping South Carolina. We are aggressive in Virginia, and we already own a bunch in Lexington, Kentucky, which is just a great market and the most unique market you'll ever heard of. It's surrounded by horse farms. There's 400 horse farms around Lexington, which pretty makes the city an island, because the horse farms cannot be built on. They're deed restricted. And so it makes Lexington about as unique a place as you can be. And so as the city grows in population, which it is, the city can't get any bigger because of the horse farms. And so it has to densify and grow inward and have more multi and have supply and demand issues. So Lexington we're in, and we're also kicking tires in Baltimore right now. We might do a deal in Baltimore but that's all like kind of middle of the East Coast kind of thing. So.
Mm-hmm. Nice. That's so interesting about Lexington, Kentucky. I have a few friends that live there, but when I think of Kentucky, I don't really think much. So
yeah. Hey, you think of horses and bourbon, it's unbridled spirit. That's the name. That's their mantra. But it's a lovely place. So
yes. So this is actually a question that I thought of when I was watching the end of your presentation. So you mentioned something that, a lot of people are moving towards blended funds, and you are actually kind of doing that as well. What do you really mean when you say by blended fund? Could you break that down a little bit more?
Sure.
How is it blended? What are the ingredients?
I'll say what we're doing, and I'll say what everybody else is doing, right? So
yes.
what everybody else is doing is, I think that they're realizing investors want a place to park capital, and they want to solve the problem of syndicators having to start and stop, start and stop, start and stop. It's like, okay, I got a deal. Everybody come in, let's do the deal. And then, no deal for like a month and a half. And then all of a sudden, I got a deal. Everybody come in and do a deal. So what a fund will allow you to do is to keep the door open and continually raise money as you need it, right? So it helps the syndicator out. It also helps the investor because the investor gets diversity. So it's not, I'm investing in that one property that syndicator is doing. I'm invested in like maybe the next 3 or 4 or 5 that they're doing. So it benefits perhaps both parties. But what the failure that I see in that is that, and it's just not complex enough for us, because what we're doing is a little more complex, but it's elegant in its own way too. So what I just described is still all multifamily, right? But if you look at what Wall Street produces in funds, there's not like, oh, this is the oil and gas fund, and all we invest in is oil and gas. So it's pretty much, you might as well just buy Exxon stock, right? What Wall Street does from funds is they'll be an energy fund, and they'll invest in oil and gas and hydro and water and solar and maybe wind or whatever. They blend it across the efforts and slightly different diverse asset classes. What we're going to do is we're doing a fund that's in it's going to be multifamily, but also in other types of asset classes like hard money loans, distressed mortgage notes, things that have a shorter time frame. And here's why, right? If I invest in a fund that's in a bunch of multifamily apartment buildings, unfortunately, multifamily, just because of the way it is, it's just not a very fast moving animal. So it takes like 5 to 7 years to make it come around. It's hard to make money in multifamily in a year. That's why people don't give you money back after a year, because it's the cake is still in the oven, if you will, right? So what we're developing is something that we wanted to create liquidity. And I've seen a lot of investors want liquidity. And so we're going to create something that has that. And so we're going to be able to give people their money back a lot sooner than 5 to 10 years. We're going to be able to giving it back on a shorter time frame, and you will also allow them to compound interest, which syndicators are not really able to do. You can't now, Haley, for other investments that folks may have through Quest, they can surely compound. And as an IRA investor, and I do invest with my IRA too. If I put $100K into a deal, the biggest curse that syndicator can do is pay me, because then it's like, oh, okay, now I got $2,000 sitting in my IRA account with Quest Trust, right? What do I do with that? I can't buy any more shares of Joe Smith's syndication fund. What do I do? Well, I have to call Haley up and say, Haley, can I buy, a bunch of shares of Microsoft or something like that? But what compounding interest will allow you to do is you can take that $2,000 and buy more of the thing that you're invested in. But you can't do that with a syndication, because there's only but so many shares. And it's not like we're adding rooms to the multifamily apartment building that you can buy as you compound your interest. But with a blended fund, you can allow people to buy more and more of it as your distributions come in. And as an IRA holder, that's something that makes a ton of sense, because then I can air quote set it and forget it and just let it accrue, and I can participate in the joy of the eighth wonder of the world, compounding interest, and watch my IRA do like this. So,
wow, that was a great answer.
You can tell I've thought this out.
Oh yeah, definitely.
We thought about it a little bit.
Good to hear, right?
Yeah.
All right. So we've got just a couple more questions here, guys. I will let you know if you've got a really long, specific question, I would recommend reaching out to Matt directly, maybe to continue that conversation. But you did talk about some of the markets that you invest in, but we've got a question here. Do you have any experience in Ohio?
We've looked at it. Lexington, believe it or not, is like 45 minutes from Cincinnati. And so for me, I won't, and this is why I'm not like this syndicator that's like, I'll go anywhere in America, but the reason for that is because of property management. Right. And so I've had property managers do awful jobs, and I've had property managers do phenomenal jobs. And so the reason why I want to invest anywhere is because I don't have PM relationships in those cities. And we're not big enough really yet at DeRosa to own our own PM company. We maybe one day, but that's not a goal right now. And that's not where we're at right now. And so I need to invest where I've got super strong property managers that I know can crush any deal that I put on their plate. So we looked at Cincy only because it's close enough to Lexington that my Lexington PM would be open to stretching there. But that's as far in Ohio I've gone. I know I've heard a lot of good things, but again, like I said, there's only but so many hours in the day and only but so many deals you can look at. And we are drilled down deep infiltrating syndicators. We like to know every deal in every city, every broker and that. So we tend to set up shop and like camp out in a city, versus like, sprinkle it around. And that, so that's another reason why not Ohio, although we've looked at the fringes of it.
Nice, nice. So going to try to ask this question, maybe reword it a little bit. So if someone's looking to purchase an apartment complex, maybe around 100 units, what advice would you have for
Yeah, you got
someone looking to
Mike's
get into
question
this
here.
type of investment?
Yeah, I got it. I'll take care. I'm glad you asked Mike's question. So Mike, here's the deal. If you're gonna go agency, it's gonna take anywhere. What's weird, Mike, is your first deal with agency debt's gonna take like 30 days longer because the agencies have to sniff you. They got to sniff your tail, and make sure that you're gonna be a good borrower and make sure that you are going to be, just a good borrower for them, right? Once you've gotten through your first agency deal, when I say agency, I mean Fannie Mae, Freddie Mac, right? So once you've done a deal with either one of them, you've kind of got the keys to the kingdom and you can close with Fannie Mae in about 45 days, with Freddie Mac in about 60. Once you've closed a deal and they don't talk. So Fannie Mae, you got to close your first deal with, and then Freddie Mac, you got to close your first deal with them. Even though their names sound almost the same, they don't even speak to each other, right? So, it can take a little bit, and it can be a little bit of a journey, but it's worth it because then you kind of get fast tracked for your next deals.
Yes. And I also want to say with that, your network is so important, especially when you're looking to do these large deals, raising private capital, no matter how you might be doing it. Definitely don't underestimate the power of your network there.
Mm-hmm.
Um,
I can tackle, Costin's question too. I mean, I'll happily go there. I mean,
yes,
I don't
yes.
get too into
Let's keep it
politics or
nice,
whatever.
but yes,
Of
I
course,
was
no,
gonna reword it a little
I
bit.
don't play politics and everything like that. Constant, you got it. A lot of things you're referring to there are regional, and so you've got to like invest in places that I would call landlord friendly, right? And there are pluses and minuses to every market. It's not like, oh, red state, blue state, whatever. There are pluses and minuses to every place in the U.S. and that. So I would evaluate the market as a whole. And I think that, I would just say that I would look at the market and look at things like, are there big eviction bans or, that are more regionally specific eviction bans or, free rent, no rent kind of thing and that. And if you want to participate in that in exchange for getting likely the way higher rents that they get in Portland, then maybe that's a risk you're willing to take, but you got to evaluate each market by market and make those part of your evaluations.
Yes, awesome. So, Matt, this has been such great information. I'm so glad we brought you back tonight, and I got to speak to Liz this week as well. So it's great to see both of
Woo!
you.
Wall to wall
Um,
Faircloth, right?
yes. So before we sign off for the night, and yes, Mike, we will be sending out the recording. You can find it on our YouTube as well. But Matt, do you have any last kind of closing thoughts, statements, or piece of advice for all of our viewers out there before we sign off for the night?
Yeah. I'm not, I believe in that. I believe that we will come out of this thing as a country much stronger. Call me an optimist, but to me, like the alternative to being an optimist just doesn't appeal to me. So, and so I believe that we're going to come out of this thing stronger. And I think that we'll look back on this time 5-10 years from now, and there will be those that sat on their hands and waited for the perfect storm, either waited for the things to crash or waited for the things to get a little bit better or waited for things to cool off or whatever. And I have young kids, so I read my kids a book called Oh, the Places You'll Go. And Oh, the Places You Go talks about a place called the waiting place. And that's literally where you pretty much waste your life just sitting, waiting for something to happen, waiting for the phone to ring, waiting for a fish to bite, waiting, right? And so that book, believe it or not, really speaks to me when I read it, because I believe that those that look back on this will realize that you could just sit and wait for things to happen, or you could just take action and have faith in yourself and faith in your resources and faith in your community, that if things don't go the way you thought they were going to, you will have the tenacity to figure it out and make it work. There's a lot of what ifs you can play. Well, what if the bottom drops out? What if the economy? What if rent evictions and moratoriums and all these other kinds of things? But Mark Twain said that I've worried about many things, most of which didn't happen, you know? And so he's right. Like 99% of things that we think are going to happen don't happen. And the things that you don't think about, nobody thought COVID was going to happen. Right. So the majority of people that worry about stuff, that doesn't happen, but something else they weren't even thinking about does happen. Right. And we still figure it out. And so I believe that it's not like now's the time. It's always the right time. And if you've used the right parameters, the right rules, and the right rules of engagement for getting involved in real estate and for a business plan, and not just willy-nilly figure it out, but if you march forward with certain goals and with certain rules of engagement for yourself, I believe if you have faith in yourself for being able to figure it out, you're going to be fine. And that's worked for me for the last 15 years, and we've done very well by rarely stopping, just continuing to keep moving, figure it out, one foot in front of the other, keep moving, shake it off, move on. And so I think that those are going to those that figured out a way to mitigate their way through the next couple of years are going to be the ones that are going to be super successful. Those that sat on their hands are going to be the ones that ended up maybe losing a couple of years of their life just waiting on things to change. So that's my 2 cents.
Awesome. Well, what a great note to end on. We always need that reminder sometimes, you got to keep going, keep pushing, don't wait, because you always end up waiting for the perfect time, and there never is a perfect time. So you might as well do it now.
If things happen, we'll figure it out. We figured it out in March. It sucked. We figured it out in April. It sucked too. We figured it out. We moved forward, and hey, here you and I both are. We're sitting here today, and
right?
and tomorrow will happen too. And guess what? If something happens tomorrow, we'll figure it out. Even if like zombie apocalypse happens, like some people think, guess what? We'll figure it out too. And I just have had proof in my life and my age that I tend to figure things out, and I just try not to worry too much and have faith that if I just keep moving, I will figure it out. So.
Yes, it's such a great note to end on. Matt, thank you so much for joining us here tonight. To all of our attendees out there, thank you so much for spending your time with us. I hope you found it valuable, and be sure to join us for our other events. Reach out to us if you have questions. Reach out to Matt. Be sure to text DayRosa to 66866. I'm going to do it myself once this webinar ends, and I'm excited to see your other resources. And I'm excited to link up with InvestHer as well. You ladies out there, InvestHer is a great resource for you. I've done a lot of stuff with the group, and it's been a joy. So Matt, have a great night. I know it's late over there on the East Coast, so we'll see you later. And to everyone else out there, y'all have a great night as well.
Thanks, everybody. Thank you, Haley.